this session of our course on Financial Institutions and Market. I am Dr. Sonam Badoria, Assistant Professor at Swami Rama Himalayan University. In today's lecture, we will compare three major categories of financial instruments: equity, debt and hybrid instruments. This comparison is fundamental for anyone studying finance, managing a portfolio or working in corporate funding. Each of these instruments serves a unique purpose, comes with different risk return profiles, and appeals to different types of investors and issuers. Let's begin by understanding the basic definitions of these concepts. First is the equity instruments, such as equity shares, represent ownership in a company. Investors in equity become part owners and share in the company's profits and losses. Their return depend on the company's performance and they have voting rights also. Debt instruments such as debentures, bonds or loans represent a loan made by the investor to the issuer. In return, the issuer pays fixed interest over time and repays the principal on maturity. Debt holders are creditors, not the owners. Hybrid instruments such as preference shares, convertible debentures, warrants combine elements of both equity and debt. They are structured to offer fixed return like debt but also give the investor the possibility of participating in equity upside. Let us now systematically compare equity, debt and hybrid instruments on various important parameters. First is the ownership and control. If we talk about the ownership and the control, equity instruments confer ownership rights to investors. Equity shareholders are co-owners of the company and have the right to vote on important company matters such as the election of directors, mergers and policy changes. Debt instruments, in contrast, do not confer any ownership rights. Debt holders are creditors, they have no say in the management or decision making of the company. Hybrid instruments like convertible debentures or preference shares may begin as debt or quasi-equity, but may convert to equity under certain conditions. Until converted, the investor is not an owner and does not have any voting rights or may have restricted voting power in specific cases. If we talk about the risk profile of equity, debt and hybrid instruments, equity is the most risky of the three. Equity shareholders are paid last in the event of liquidation after all debts and preference obligations have been made. Their returns are not guaranteed and depend on business performance and market sentiments. Debt is less risky because interest payments are typically fixed and legally binding. In the event of liquidation, debt holders are among the first to be paid. Hybrid instruments carry moderate risk. For instance, preference shareholders are paid before equity holders but after debt holders. Convertible securities offer safety in the form of interest income and they have the potential of capital gains if converted to security. Then next is the return potential. If we talk about the return, equity offers unlimited upside potential as there is no cap on capital gains. If the company does well, share prices rise and dividends may be declared. Debt offers predictable fixed returns. The returns are generally lower than equity but more stable. Hybrid instruments offer a mix. Investors earn fixed return initially and may participate in equity growth upon conversion. Warrants, for example, give no fixed income but offer substantial gains if exercised profitably. If we talk about the tenure and maturity, equity has no maturity date. Equity shares remain in existence until the company is wound up. Debt instruments are issued for a specified period like 5, 10 or 15 years, and the principal is repaid on maturity. Hybrid instruments may have a fixed term, especially if they are redeemable or convert after a certain period. For example, a 5-year convertible debenture might convert into equity in year 3. Next, the obligation to pay. If we talk about the payment obligations, companies are not obligated to pay dividends on equity. Dividend declaration are discretionary and depend on profitability and board directions. Debt instruments create legal obligations. Interest must be paid regardless of profit or loss. Defaulting on debt can lead to lawsuits or bankruptcy proceedings. In hybrid instruments, obligations vary. Preference dividends, if cumulative, must be paid eventually. Interest on convertible debentures is a legal obligation until conversion. Then, if we talk about the tax treatment for these three, for companies, interest rate paid on debt is a tax deductible expense, reducing the effective cost of borrowing. Dividends on equity and preference shares are non-tax deductible, making equity more expensive from the company's perspective. From the investor's side, interest income is taxed as ordinary income, while dividends may receive favorable treatment depending on tax rules. Capital gains from equity investments held long term often attract lower tax rates. If we talk about the liquidity, equity shares, especially those of listed companies and are highly liquid at trading activity on stock exchanges. Debt instruments, while also listed in many cases, intend to have lower liquidity, especially if they are not government bonds or highly rated securities. Hybrid instruments like preference shares or convertible may have limited liquidity, depending on market interest and listing status suitability. Now, if we talk about the suitability, equity is the best suited for growth oriented risk tolerance investors who can afford volatility in pursuit of higher returns. Debt is ideal for conservative investors looking for stable income and lower risk. Hybrid instruments are suited to moderate risk investors seeking a balance of fixed income and potential capital appreciation. Let me now summarize the advantages and disadvantages from the perspective of companies and investors. If we talk about companies, equity financing avoids repayment pressure but results in dilution of control and is costlier in terms of tax treatment. Debt is cheaper due to tax savings and does not dilute ownership but increasing financial risk due to mandatory payments. Hybrid instruments offer flexibility, allowing companies to delay dilution or tailor terms based on market conditions. For investor, equity offers high potential returns but with significant risk. Debt provides certainty of income but limited upside. Hybrid offer a compromise, making them attractive in uncertain markets or for portfolio diversification. Let's also take a moment to understand what is a quick scenario. Imagine you are an investor with rupees 1 lakh to deploy. You could invest in equity shares of a growing company, hoping for capital gains over the next 5 years, or you may invest in a non-convertible debentures paying 9% interest annually, giving you rupees 9,000 per year in income, or you can invest in a convertible bond offering 6% interest with the option to convert to equity if the company's stock crosses a certain price. Each choice has trade-offs. The right one depends on your risk tolerance, return expectation, time horizon and confidence in the company. To wrap up, let's review. Equity shares means the ownership plus high risk plus high reward. That means creditorship, low risk and fixed return. Hybrid means a mix of both, balancing risk and return. Understanding these instruments and how they differ is crucial for financial decision making, whether you are managing your own investments or making capital structure decisions in a company. So, as we conclude, here are few questions to reflect on. You should think how companies should choose between equity, debt and hybrid financing options. What should be the ideal mix of these instruments in an investment portfolio? Or how can macroeconomic factors like interest rates, inflation influence the performance of each type of investments? Thank you for joining me in this important comparative session on equity, debt and hybrid instrument. In our next lecture, we will explore securities issuance and trading mechanism, learning how securities are brought in the market and how they are traded in the secondary market. Until then, stay curious, stay disciplined and continue building your understanding of financial systems. Thank you. Namaste.